What's the true cost of an employee? Beyond their salary, many companies use an increasingly popular form of compensation, shares. But how do you account for something that isn't a simple cash payment? That's exactly what we're going to explore today. We're diving deep into IFRS 2, share-based payment, the standard that ensures we get a complete and transparent picture of a company's financial health. IFRS 2 is an international financial reporting standard issued by the IASB. Its primary objective is to specify how a company should account for share-based payment transactions. In simple terms, it requires an entity to recognize these transactions in its financial statements, ensuring that all forms of compensation, whether cash or equity, are fully captured. This is vital for transparency and helps investors and stakeholders compare companies accurately. The scope of IFRS 2 is broad. It applies to all share-based payment transactions, and it's not just for employees. It also covers other parties who provide goods or services in exchange for a company's shares. This includes equity-settled transactions, where the company gives its own shares or options. Cash-settled transactions, where the company pays cash based on the value of its shares. And transactions with a choice of settlement, where the company has the option to settle with either equity or cash. To master this standard, we need to know the key terms. A share-based payment transaction is one where the company receives goods or services in return for equity instruments or incurs a liability based on its share price. Equity settled means the company is exchanging goods or services for its own equity instruments. And cash settled means the company is paying cash, but the amount is directly tied to the value of its shares. The core principle of IFRS 2 is simple: you must recognize the goods or services received in a share-based payment transaction when they are provided. If these goods or services don't qualify to be recognized as an asset, they are immediately recognized as an expense in the profit and loss statement. Measurement is where it gets interesting. For equity-settled transactions, the general rule is to measure the fair value of the goods or services received. But for employee services, which can be hard to measure, we use the fair value of the equity instruments granted instead. This fair value is determined at the grant date and the expense is recognized over the vesting period, the time until the employee is fully entitled to the shares. For cash-settled transactions, you recognize a liability for the fair value of the obligation, which must be remeasured at every reporting date. Any changes in that fair value go straight to your profit or loss. Vesting conditions are the hurdles a counterparty has to clear to become entitled to the share-based payment. Service conditions require a specified period of service. Performance conditions require the achievement of specific targets. There are also non-vesting conditions, which are factored into the initial fair value measurement. What happens if the terms change? If a share-based payment is modified, the entity must recognize at least the original grant date fair value. Any increase in value from the modification is recognized over the remaining vesting period. If a transaction is cancelled, it's treated as an acceleration of vesting, and any unrecognized expense is recognized immediately. IFRS 2 requires extensive disclosures to help financial statement users understand these arrangements. This includes providing a description of the arrangements, how the fair value was determined, and the total expense for the period. For example, a company would recognize the fair value of employee stock options as an expense over the vesting period, while for share appreciation rights, they would recognize a liability that is remeasured at each reporting date. To summarize, IFRS 2 ensures that all forms of compensation, especially non-cash, are consistently and transparently accounted for. It requires fair value measurement, recognizes the expense over the vesting period, and emphasizes robust disclosure. This standard is crucial for providing a true and fair view of a company's financial performance. Like and subscribe to view similar content.